Hi, everyone. I'm here with Unchained Executive Editor Steve Ehrlich. Welcome, Steve.
Hey, Laura.
You wrote a really interesting article recently about how DATs are using locked tokens in what I will just call creative ways. Why don't we first start with, what are some of the common misperceptions about locked tokens?
Yeah, so this was an important place to start the story because one of the things that we both know is that in crypto, they try to sort of appropriate TradFi terms to make the industry seem more decipherable to people. And oftentimes, I've seen this over years and years, and I'm sure you have too, Laura. The terms locked tokens and vested tokens or vesting become conflated to the extent that most people use them as synonyms. But that's very much not the case. Anyone that's ever held stock options in perhaps a private, like venture-backed company knows exactly what vesting means. Typically, it means you get a certain allotment of shares, often with a 1 year cliff, and then perhaps quarterly or monthly um, vesting through 4 or 5 years. And the key part here is that with options perhaps that are going to vest, they can be forfeited. They can be forfeited if you leave the company of your own volition. They can be forfeited if you're terminated, either for a cause or just downsizing that has nothing to do with your actual cause, nothing to do with your actual performance at work. Lock tokens, what I learned in the course of this reporting, and it was kind of a suspicion I had as I went about the story, is that they can mean a lot of different things. And it really just depends on the person that you're asking. Typically, lock tokens are presented as like these tokens are behind some sort of vault in some sort of smart contract, out of circulation, and they're not supposed to move. Or I guess the perception is, or misperception is, that they're not going to move until some sort of quote unquote vesting schedule has been met. But what I found out in the course of this reporting, and this isn't even just related to DATs, but lock tokens, they can move. They can move between holders. They can move between custodians. Lock tokens can often be staked. And really, it seems like the only common denominator between all the different ways of using lock tokens is that they don't enter sort of circulation to the extent that you can buy them on spot markets. But there's a lot going on behind the scenes that falls under the I guess, the term locked tokens.
So, what did you find out about how DATs are using locked tokens?
So DATs are sort of following the playbook first started by VC firms that would often buy sizable allotments, 8, 9 figures of these tokens, often at a discount. And this discount can vary from 15%, I think, to as much as 60% is what I found in one of the companies I investigated. And, and obviously that can be very very profitable for these firms because they're buying at a discount. And then because of a lot of the hype surrounding that, especially in the late spring, early summer, they still traded at a premium despite what could have been, despite a potential illiquidity discount that was applied to the purchases. Investors in the actual stocks seemed to ignore it. That was all part of the hype. But then what really was, I guess, doubly beneficial for these companies is that not only were they buying the locked tokens, they were able to get those tokens and then issue shares that would become liquid much sooner than the tokens, that then they could be sold on the public markets. So they got the benefit of buying in bulk at a discount, but then were able to basically sell the shares at a premium that were backed by locked tokens to retail investors. So it's a really terrific way to juice earnings if you're able to buy at sizable discounts in bulk, but retail investors don't seem to care about that when they're pricing these assets.
Actually, there was so I understand what you're saying, but also I thought that another group that was benefiting is the insiders who, like, if they had been allocated locked tokens, then they put them in this DAT, and then they get liquid shares back that are trading at higher, MNAV than
Yeah,
one, and then they can get liquidity faster and also, yeah, at like a much higher valuation. Is that
yeah, that's true. I mean, that's part two, because with some of the companies that I looked at for the story, I mean, I looked at SWE Group, which partnered with the SWE Foundation. I looked at Stablecoin X, which partnered with the Athena Foundation. I mean, there's others too. They partnered with the issuers or the insiders of these tokens, and when those foundations they put those locked tokens into the exchanges, they then would get liquid shares back. I mean, SWE Group, for instance, uh, they in the SEC filings in the 8K when all this was announced, there was language to the effect that tokens put into the debt were going to be locked for 2 years from, I guess, the finalization of the business combination agreement. And to me, that immediately led to some questions because clearly they're changing whatever lock schedule was prior to these tokens if they're going to say there's going to be a new locked schedule from here on out. Then what I also saw in the filings is that many of those shares backed by the locked tokens and the tokens will be locked for about 2 years will become unlocked after 1 year, some as early as 6 months. So that's clearly benefiting some of these insiders. Those aren't even the most egregious examples. I mean, I wrote a story a few weeks ago about an AI focused blockchain called Zero Gravity. And in that case, and this is an example where virtually everyone in the industry I've spoken to said this is the exact example of what not to do. The founders of that blockchain put about $300 million of locked tokens into the stat, and then they got liquid shares immediately. And that's the most egregious example. But this is certainly a way for some of the foundations to get liquidity against illiquid assets. So there's a few different opportunities for insiders in these groups to really benefit financially from, I don't know if taking advantage of is the right terminology, but being creative in how they're using these locked tokens.
And you mentioned Sweet Group and Stablecoin X, and as you also said, there are other companies that are
Mhm.
doing this. These are just the ones that you happen to write about in the article. How did they respond when you asked them, questions about what they were doing here?
So it's funny. Both Stablecoin X and Sweet Group, their rationale basically was, well, we looked at what everyone else was doing, and we're the most conservative. Or this is, or something to the effect of this is within market trends. It wasn't necessarily like, well, actually, to be fair, I mean, Stablecoin X, they gave me a bit of a longer explanation, and they also said that like, look, for some of these tokens, if there's not enough liquidity, that can lead to jarring price movements up or down, and they want to try to smooth the market, seed it with enough liquidity, almost like a market maker to an extent. I'll leave it to people reading the story and listening to this interview to uh, judge for themselves if they think that's a good enough reason. But it was funny when I spoke to people, they basically said, "Well, we're not being as egregious as everybody else." That was primarily the rationale. So I mean that's kind of what I heard. I mean, there's nothing ostensibly illegal about this, from what I can tell. It's just again being very creative, and there's lots of information like this hidden in SEC filings when it comes to these tokens, and um, it comes down sometimes to the information asymmetries between the insiders who are putting all these deals together and then the retail investors that either don't have the time or don't have or just don't know where to look to find out this information, and it's important for people to have, so that's why we write about it.
Yeah, one other piece of it that I thought about was that by those insiders who had initially been allocated the lock tokens, by them getting liquidity via the DAT shares, they sort of, you could say, they're kind of like cashing out early, and it might decrease their incentive to keep working on the project and to, like, it's almost like their incentives are no longer as aligned with the community. So that was like another kind of downside that I thought about.
Yeah, absolutely. I mean, there's a reason why there's vesting schedules for key executives in venture-backed startups. I mean, you want to keep them incentivized to work over a long period of time. And the same goes for token foundations and blockchain foundations. You want key people there. Long-term interest alignment is critical. So if there are opportunities for early exits, sometimes they can be very difficult to say no to, depending
Yeah.
on someone's financial circumstances, etc.
Yeah. Okay. Well, that was super interesting. Thanks so much for sharing about your story.
Yeah, thanks, Laura.